I want you to stop spending on the frivolous things and focus your money on spending in the market. Guys, we need to stop spending so much money. I believe there's a recession coming. Now, on this video, I want to explain to you guys why I believe there's a recession coming and why I believe we need to slow down our spending, but at the same time, continue to spend in the market. And I'm going to explain that to you guys a little later in the video. Guys, most experts are expecting to see a recession later on this year. Now, how big that recession is going to be, we're just not sure, and it's just not clear yet. Now, what is a recession? Just to be clear, a recession is simply a significant, widespread, and prolonged downturn in the economic activity of a country, or the more textbook version of a recession is 2 straight down quarters of a nation's GDP, gross domestic product. Now, GDP is just the monetary value of all of the goods and services that are produced in a country in a set given time. And we usually measure GDP in quarters, right? Every 3 months. The textbook version is when 2 straight quarters of the GDP is down. That's what we consider to be an economic recession, or if we see some type of significant decline in economic activity. So one of the most important signs of a recession is higher unemployment. Now, higher unemployment has happened in almost every recession that America has ever went through. However, we know that right now, our unemployment in America has been for the last 3 or 4 or 5 months or so, guys, it's been between 3.4% unemployment to 3.7% unemployment, which is 50-year lows in unemployment. And so right now, that means lots and lots of people are working. And there's plenty of available jobs out there for almost everybody. Despite the fact that the Federal Reserve has been raising rates, they've raised rates 9 straight times in a row, and they're about to raise interest rates again, or the federal funds rate, for a 10th straight time, more than likely. And they've been raising those rates to slow down spending and to hopefully increase unemployment just a little bit. Now, despite all that from the Fed, unemployment has remained low. So the huge indicator of unemployment that usually signals or works in conjunction with a recession is just not happening right now. So you may be saying to yourself, hey, unemployment is real low, so that's no signal that we're going to have a recession. What's going on? You're right. It's not a signal that we're going to have a recession. And not to mention the fact that experts are predicting that the GDP is going to increase by 2 to 3% over the next several quarters. So again, high unemployment, GDP going up steadily, and you're probably saying those are not signs of a recession. And guess what, guys? You are 100% right. Those aren't signs of a recession. However, here's a few things to think about, and here's why I say I think a recession is going to happen. The first thing is consumers, us, we've relied largely on increases in wages. Now, it's no big deal for wages to increase, but wages have been increasing consistent with higher inflation. And when wages increase consistent with higher inflation, then that doesn't spell a good sign for inflation. And that's one of the reasons why inflation has not gone down as quick as the Federal Reserve thought it would, right? So wages have been raising too much too fast. The more people have to spend, the more people will actually spend. And when more people spend, that's not a good sign for bringing inflation down. Wages should not be rising at a rate that's consistent with 4 and 5 and 6 and 8% inflation. Wages should be rising at a rate that's consistent with 2% inflation, the Federal Reserve's target inflation rate. Now, another thing is the pandemic money. Guys, the pandemic money, and when I say pandemic money, I mean the money that was put out in the economy through stimulus checks and low interest rates. All that money that was out there is starting to cool off and starting to sort of go away. We also know that student loan repayment is about to kick back in. Whether or not the Biden administration's debt payoff plan is going to go through or not go through, one way or the other, student loan repayment plans are going to start up again. People will have to start paying on student loans. And we know that savings rates are down, meaning that people are actually saving less money. Now, some of that is the fact that prices are higher. And when prices are higher, people can't save as much. But at the same time, people are still continuing to spend. And some of that money that was out there in the economy flowing freely and pushing the economy to actually work during the pandemic, that is coming to an end soon. And another interesting thing to think about in terms of a possible recession is the fact that American households racked up a record $180.3 billion in credit card debt last year. And during that same time, credit card delinquencies also went up, which indicates to me, guys, that people have been living more on borrowed money. And people living more and more on borrowed money is a sign of disaster at some point down the road when that money ultimately runs out. Now, another thing is this: the Fed is likely going to keep interest rates high for the foreseeable future and continue to press on getting everybody to spend less money as they continue to fight inflation. Now, next week, the Fed is meeting again, and they're expected to do another 25 basis point increase in the federal funds rate, which will be the 10th increase in the last year or so. And that will push the federal funds rate up and over the 5% mark for the first time in maybe 16 or 17 years. Not to mention the banking crisis. If you guys remember the banking crisis from just a couple of months ago. Now, you don't hear about that very much in the news right now, and that's in part because of the Federal Reserve propaganda machine, which moves things in and out of the media cycle and the news cycle very quickly, right? Things that they don't necessarily want sitting in the news cycle. And the banking crisis that happened just a couple of months ago, it still has some lingering effects, right? So we had the two runs on the bank, Silicon Valley Bank and also Signature Bank of New York. And the lingering effects of those two runs on those two banks has sort of meant that more banks are more stringent on their lending policies and lending procedures, especially the smaller banks. Now, you talk about big banks, the big tier one banks like JP Morgan Chase, some of those big banks, they weren't affected nearly as much as some of the smaller banks, right? And some of the smaller banks are having to sort of keep their head above water in the meantime, following what happened with those run on those banks. So the point is that the small banks are going to be lending less money, and that's going to mean a hit to middle, regular, average, everyday Americans in terms of trying to get loans from those smaller banks when they go to get auto loans or when they want to go get home loans, etc. And speaking of home, we know that the mortgage interest rates are up and over 6%, which is causing less and less people to go out and buy homes because many people have locked in at 3%. And who in the world would ever trade a 3% mortgage for a more expensive 6% mortgage, right? Unless they have to, of course, right? Some people are forced to do it, but most people don't want to do that. So all of this is to say that we as consumers, guys, we need to get to the point where we stop spending so much on the consumer stuff. Now, later in the video, I'm going to tell you where you want to be spending your money more so than just in terms of the consumer side, because we don't want to be spending money on the wrong things. We want to be spending money on the right things. So I'm going to explain that to you in a minute. But just to know, guys, that we as consumers, as a collective, we play a large role in the economy or where the American economy goes from here. Right? Our spending matters. As is right now, spending on things like homes, furniture, electronics, all those things are down. However, spending on things like travel, leisure, hotels, those things are actually up, believe it or not. Now, the other thing I wanted to point out to you guys is this. Recent reports show that consumer confidence is beginning to go down. Consumers are being more and more pessimistic about the American economy. Now, that's really important too, because that usually translates into a slowdown of an economy, a slowdown of spending when people begin to get to the point where they're a little bit shady and shaky and they're not as confident as they were. People stop spending as much. So when people slow down their spending, that's an indication, guys, that a recession could happen. History says basically, guys, that the S&P 500 could reach a low later this year. Now, this is where you want to pay attention, guys, because when the S&P 500 or the stock market in general hits a low, you want to be in the process of spending when that happens, guys, spending on purchasing stocks, mutual funds, ETFs, index funds. You want to be in there in the market participating when the market takes a hit. So I want you to stop spending on the frivolous things and focus your money on spending in the market. Right? Your investments, continuing to invest no matter what happens with the market through a recession or through a bear market. In other words, guys, the stock market tends to look forward. So when I say the stock market tends to look forward, it simply means that future events anticipated by current investors are priced into the market before those events actually occur. For example, during a bear market. Now, let me explain what a bear market is. A bear market is simply a decline of 20% or more in a major stock market index. So a major stock market index would be like the S&P 500. When it declines 20% or more, when it goes down 20% or more, that's considered a bear market. So every single bear market, guys, since 1948, that's 75 years or so, every single bear market has started before the onset of an actual recession. But each of those bear markets stopped before the end of that recession. So here's the recession, right? The recession, everything's going down, down, down. Here's the market. Here's the bear market. Things are going down 20%. Well, that turns around and goes back up before this recession hits bottom. So I hope that makes sense. And so this is why I say, if you're going to spend any money, be spending money in the market right now, because every single bear market stops and takes a turn before the end of every recession, right? Before that recession hits the bottom, that bear market turns around and goes back up, and it goes back up sharply. Continue to invest through that bear market. That's why I say we need to stop spending right now as consumers on some of the frivolous things, right? And make sure that we're actually investing in the stock market right now with our spending. And that is how you build serious wealth, guys. Because on this channel, I don't just want to tell you what's happening in the economy. I want to tell you what you need to be doing in the economy to actually make this economy and this market work in your favor. According to Hartford Funds, 42% of the S&P 500's strongest days in the last 20 years have taken place during a bear market. And another 34% of its strongest days have taken place during the first 2 months of a new bull market before it was even clear that the old bear market was over. So again, as the bear market drops and drops and drops, you need to be invested in the market because it's going to take a turn real quick and go up quickly and fast before that recession hits the bottom, right? So consider this example, guys. If you had invested $10,000, just $10,000 only in the S&P 500 at the beginning of 1993, that $10,000 would have grown to $158,400 by the end of 2022. Now, that's a 30-year history of a near 1,500% return. And the reason I say that, guys, is because at the beginning of 1993, that was when everybody was predicting that they were going to have some terrible year in 1993. Bear market was happening and they thought things were good. But 1993 turned around and became like one of the strongest years in terms of S&P 500 growth. And that's what happens in a typical bear market at the beginning of a recession. So that's why you want to be investing as much as possible, because that's how you grow wealth. And you don't have to time all of that. Don't try to time the market, right? Just be investing in the market the whole time, and then you will reap the benefits. Just simply keep investing your money through bear markets, through down markets, through a recession. That's all you got to do, guys. And I think that despite all of the rosy picture that we sort of see right now, there's some indicators that we will have a recession at some point. Please, please, please do me and do yourself a favor. Continue to invest no matter what. Slow down your consumer spending and up your investing in the market. Guys, if you got anything at all out of this video, do me a favor, smash the like button, and please consider subscribing to the channel if you're not a subscriber. Check out a few of these videos that I put right here, guys, for more information. The best person to take care of the old you is the young you. Take care of yourself and always take good care of other people. Until the next video, peace!